All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I are going to take a walk through ordinary life and talk about the stocks that you encounter on that walk. This could be a great exercise to help you find investment ideas and also kind of open your eyes to what is out there as far as things we use and familiarity and finding investment ideas. So with that, Andrew, let's take a walk. So where should we start on our journey to discover unfound or forgotten kinds of companies?
Well, we could go two directions, so I'll give you the option. I think normal, healthy people would brush their teeth when they wake up. I go straight to my Keurig. So we could go one of two ways. Yes, I am that guy, and I just said that for a bunch of people. Awesome.
Yeah, right.
Which way do you want to go?
I'm going to choose the Keurig way because that's the way my wife and I go, is we go to the Keurig first and then brush our teeth after we have the coffee.
Perfect. So. All right. Awesome. Keurig Dr Pepper. The ticker is KDP. I've got Fiscal pulled up so I can just throw some stats at you guys.
Okay.
I don't know how much you know about them. They kind of have an interesting backstory, I guess. But
I don't.
Okay. I'll start on this one then. So there was like a merger acquisition type deal with Dr Pepper and Keurig, but they're growing at mid-single digits, revenue at 15 billion, net income margin at around 10%. So like 1.5 billion in profit. Is that a bigger company, a bigger business than you would have thought? Like, keeping in mind Pepsi, Coca-Cola, Dr Pepper, and then they also randomly have the whole Keurig business.
Right. Yes. Well, no. I guess it's smaller than I probably would have thought.
Okay.
I would have thought that because of Dr Pepper, that it would have been bigger. I know, coffee is a very polarizing subject, as I have discovered, and Keurig people are very particular about Keurig, and then everybody else that drinks coffee thinks that we are, uncouth, shall we say.
Right. Yeah, lower than.
Yeah, we're lower than. We're not real coffee drinkers.
That's okay.
I don't want to start a war, but to me, it's smaller than I would have thought, because I would have thought with the name brand of Dr Pepper and the beverage industry just as general, I know it's not a Coke or Pepsi, but it's pretty well known name. And you can get it at most restaurants, right? So I would have thought that would be much bigger, frankly.
Right. Yeah, so last 12 months, refreshment beverages, which I'm going to just assume, which is always a bad idea, that has the Dr Pepper. That's 9.8 billion in sales. The coffee, U.S. coffee, is 3.9 billion. Okay. So if you think about, okay, what's the Keurig business, if we're going to make that assumption that Andrew just did, Dr Pepper makes up 2 times more than the Keurig part.
Yeah. 3.9 though still seems small.
Yeah.
Yeah, for the coffee part of the business. And I mean, yes, that's a lot of coin to be throwing through your bank account, right? As a normal person, but for a publicly traded company that's got some cachet and brand name, 3.9 billion for one part of your business is kind of chump change. When you think about a company like Visa is doing 40 billion in revenue. Amazon and Walmart are doing 500 plus billion in revenue. Of course, those are monster companies, but it just seems small to me.
Yeah, Starbucks, 36.2 billion, 36.7 in the last 12 months. So to your point, when I think of the scale of a Keurig, I think everybody who knows about Starbucks knows about Keurig and vice versa.
Right.
So scale-wise, it would be the same.
Right.
But then, to your point, it's 10 times less. They must only do licensing revenue or something like that.
Yeah, probably. Yeah, probably. Frankly, this is a company I know, other than the name and a few of their products, I know little to nothing about. Would this be something you would be interested in ever learning about or owning?
My issue with it always has been ROIC is not great. And maybe that's related to the big merger, the whole Dr. Pepper Keurig thing, which I'm not going to get into, but that's always been my issue. And so it's like, okay, there's so many fish in the sea. I'm just going to move on. But could it be a great opportunity? Sure.
Yeah. Yep. Okay. All right. So we've brushed our teeth. Or I'm sorry. We've drank our coffee now, and now we need to go brush our teeth.
Yeah.
We use Crest toothpaste,
Oh,
and
okay.
which is I know owned by Procter and Gamble.
Okay. So let's dive into the big conglomerate now.
Mm-hmm.
Procter and Gamble. All right, looking at their numbers. Revenue 84 billion. Now we're talking about a big business.
Right.
84 billion. Net margins about 20%, so call it 16 billion in profit. 10 times the size of the last company we were looking at.
Right.
But growth's kind of a different story. So talk to me about Procter & Gamble and growth and all of that.
You know, it's an old company. They've been around for a very, very long time. I believe they're a dividend king. Is that correct? I know they're a dividend aristocrat, but they might be a king. And the only reason I talk about the difference is because a company that's paid a growing dividend for 50 years or more and is a certain size is considered a dividend king. 25 years or more is a dividend aristocrat. And so to pay a dividend for 50 years plus, you got to be around for a long time, obviously. So in this day and age, with tech companies going in and out of favor very, very quickly, something like Procter and Gamble that's been around for probably close to 100 years
rock.
A rock for sure.
Yeah.
And you would be surprised if you go through your medicine cabinet or your toiletry area, you're going to find a lot of Procter & Gamble products in there. So to me, you know, I don't know. I don't have the numbers in front of me, but if you told me that the company is growing at 5% or less, it would not shock me at all.
Yeah, that's pretty accurate, actually. Good job.
Thanks.
5% over the last 5 years for diluted EPS on the CAGR. So, yeah. Not huge. I mean, revenue, 3.5. So they are getting a little bit of earnings growth that's a little bit higher than revenue. But yeah, they are not knocking your socks off with cloud compute type bounds and leaps of growth. It is definitely not happening.
So what you're saying is AI is not a part of this business.
Well, I hope not. I don't know how far away from their circle of competence that would be.
Right. You know how every company is, you know, touting AI in their earnings calls lately.
Right.
You know, even companies, you're like, what the heck does AI have to do with this? But yeah, so. Oh, yeah, that's funny.
Great
All
stock
right.
for retirement, though. Like if you bought this thing 20 years ago or something, and now you're just collecting dividends every year, it's a great stock to just maintain your wealth for sure.
Yeah, if you're a defensive investor, somebody that is very risk averse, but maybe don't want to go down the bond route, this would definitely be a really good option to choose from, because you'll get a decent return, and then you'll get a nice dividend, and it's, you know, about as safe as you can get, especially for an equity or a stock investment. So, and if you're closer to retirement, this could be potentially something that would be interesting to pivot to as you're getting closer to retirement as well.
I mean, we mentioned all the brands, right? I pulled up on their investor relations, just their latest earnings call. They know what they're doing. They put a bunch of their brands front and center on the first slide of that earnings presentation. Tide, Dawn, Bounty, Pampers, Always, Head and Shoulders, Gillette, Crest, ZZ Quill, Olay. And that's probably just a smattering. So, yeah, they are definitely everywhere.
Yeah, for sure. Staying in the bathroom area, let's say that you got up early and you went to work out before you had the coffee and you brush your teeth, and your muscles are a little sore. It would be natural to go to the medicine cabinet and find some Tylenol and take some of that. So to help with the soreness before you go to work. And so the company that provides us with that is Johnson & Johnson.
Yes. Similar story, I think we might find. $90 billion in revenue, big company. Net margins of 25%, so almost over $20 billion. That's a higher margin than I would have thought. I wouldn't think of Johnson & Johnson as a high margin business, but apparently they are. ROE 30%, ROIC 15%. But like with Procter and Gamble, if you zoom out over 10 years, 2.5% for revenue, 5% for EPS.
Okay.
Not knocking your socks off with the growth, but you are getting 3.2% on the dividend.
Right. Yeah. So yeah, it kind of the same story as Procter and Gamble. The company has been around forever, and it is a stalwart in the stock market as well as in our daily lives for the products that they serve. The company, I think, is probably more a pharmaceutical business now than maybe it was in the past. And they did have a divestiture, and I don't remember all the specifics about it. It's not a company I follow very closely.
Keview.
Yeah. Yep. That's it.
So that explains why all the numbers look good now.
Right.
Because they had that spinoff. So a lot of the lower margin stuff went to Keview.
Mm-hmm.
Interesting.
Yeah.
Okay. Looking at revenue of only 15 billion and net margins of around 10, so 1.5. So now we're back at the Keurig scale.
Right.
We're at a Keurig size, and that's Keview.
Yeah.
I'm sorry, Kenview.
Kenview
is the name. Yeah.
Yeah. Yep. So again, a very stable, reliable company, great for retirement, great for more defensive type investors. If you're looking for a lot of growth, this is not an area you probably want to try to mine much.
Curious to know some of the brands?
I am.
Lister, obviously Tylenol's in there. And by the way, they are showing a bird's eye view of some woman's bag, so I almost feel dirty saying these out loud because I'm looking into her bag. But we have a Tylenol, Avena, Listerine, Band-Aid, Neutrogena. Is that Neutrogena? The sunscreen?
Yeah, probably.
And then Zyrtec. I don't know what that one is. But
yeah,
I mean, another one. But that's interesting, right? Procter & Gamble, bunch of brands, bunch of consumer brands. Johnson & Johnson, now Kenview, a bunch of consumer brands, but that scale is so different.
Right.
So like maybe people just want to buy more cleaning things than the whole Johnson & Johnson healthcare, skincare thing. I don't know.
Right.
It's weird how the stock market can work that way.
Yeah, it really is, isn't it?
A lot. Yeah.
Yeah, a lot. Okay, so let's say that we have to drive to work now. What around the car or our drive could we associate with the stock market?
Yeah, too much.
Yeah. I mean, the natural place would be to look at the cars themselves. And, there's everything from Tesla all the way down to like Ford and GM, right? Yeah. Honda, Toyota, you have BMW, Volkswagen, Porsche. It depends on how luxury we want to go. Let's live the dream. Race, RACE.
Okay. All right. So we are now moving internationally. We are in the BIT index. What is that? I don't even know.
I'm not sure. I think it might be Italy, maybe.
It's in euros, though.
Yeah.
So
okay. Yeah.
It is in euros. We do have a much faster growing company. Revenue last 3 years, 14% a year. EPS last 3 years, 20% a year. So definitely growing really fast. ROIC really high, 22%. Looks like a really good company.
Yeah. It's definitely one of the luxury businesses out there. They own Ferrari, and so they're definitely very much a luxury kind of company. What is the PE ratio? Because I think it's really expensive.
48.
Yeah. Yep. That sounds about right.
Gross margins 50%, net 23. So on that close to 7 billion, they're getting almost 2 billion in profit.
That's impressive.
It is impressive. There are different ways to skin the cat. You can have 15 billion in revenue like a Keurig, or you can do it in half as much with this Ferrari company.
Yep.
Interesting.
Yeah.
Do you want to look at Tesla, or are people sick of hearing about Tesla?
No, let's look at Tesla.
Okay.
I mean,
what have they done lately?
I mean, we just compared a very high quality company, right, with like luxury vehicles. So I think Tesla kind of falls into that same category ish.
Yeah. Do you think their PEs come down?
No.
Yeah, it's still 200. That's pretty high.
Yeah.
Revenue at 93 billion. Very big. And it is on a net margin of call it $5-6 billion in profit. Do you think it's still growing though? So last 3 years, revenue is up 11% annually. Last 5 years, up 30% annually. So yeah, last 3 years, only up 11% annually. That probably has to do with some of that. People were talking about the demand. What was it? What happened with them lately?
Like they're still producing the cars, but the demand for them has slowed a lot.
Yeah.
And then they're also doing doing price cuts as well.
That's what it was. Yeah.
To try to stimulate more demand, and that has hit definitely their revenue numbers, but also their margin numbers as well.
ROIC of 18% though, on only 6% net margin. So
okay, that's pretty good.
They're pretty efficient. Yeah.
Yeah, that's pretty good. That's pretty good. Now it's interesting, isn't it, that their profitability is so much less than race was, and it's kind of interesting. You know, they're obviously their revenue is like what 15 times bigger than race, but their profitability is quite a bit less.
The margin,
yeah, just their margins and like the over like the percentage of profit that they make from their cars.
Right. Yeah. Yep. Very interesting. Probably a lot of depreciation expense in there.
Yeah.
So we're in the car. We've gotten through all of that. Lots of car companies, by the way, are public. Honda, Toyota, Ford, GM, Tesla, Ferrari, just to name some of the big ones that come to mind. Also, you can buy VW in Germany, and they also own Audi. But I'm sure a lot of people already know that. Let's move on. Where are we driving to in this scenario? You want to stop by McDonald's?
Yeah, let's stop by McDonald's because we got to get a breakfast sandwich, right? Just like Buffett does every day.
Yeah, there you go. Now we're talking. Okay, ticker symbol MCD. Revenue only 26 billion. And then net margin is 30%, so they are at around 7 to 8 billion. Does that surprise you? That sounds low.
Very much, yeah, very low. I would have, as big a brand name and as global as they are, I would have thought it was at least a couple $100 billion.
Yeah. No, so that's the franchise model for you.
Right.
You know, another one that's really low, Domino's Pizza. Let's throw that one in there just because I'm familiar. What would you guess their revenue is?
Well, if you're telling me that that it's low and McDonald's was low, maybe 10 billion?
4.78.
That's it?
Yeah.
Wow. That's crazy.
Yeah. Yeah.
That's crazy. As well a known name that is. Yeah, that's surprising.
So what I find interesting about these two companies in particular, especially because we've been doing this a while, Dave, their growth rates have slowed down quite a bit. I remember Domino's used to be almost like a compounder bro stock.
Right. Yeah.
The effect of that over the last 5 years, stock's been almost flat.
Wow.
24% over 5 years, 24% total.
Right.
So yeah. McDonald's has also come down a bit. If you look over a 10-year period, revenue is flat. Like from beginning to end, revenue is at the same level.
Wow.
But earnings are up still pretty nicely, 11% a year over 10 years.
So that tells you they're buying back a lot of stock.
Potentially.
Most likely.
Potentially. Yeah.
Yeah. And that's, I guess when you're looking at some of these larger, well-known, slower growing companies, that's one of the ways that you can earn a decent return is when the company's buying back a lot of stock and giving you more shares of the company.
That is a nice growth lever.
Yeah, for sure.
Okay. We're in the car now. We want to switch up the playlist. So I'm going to pull out my iPhone and then we're going to pull up a good Spotify country playlist, country music. Which of those two stocks do you want to look at?
Let's look at Spotify.
All right.
I'm less familiar with that one. So
ticker SPOT, just a few rapid fire metrics. Revenue at almost 17 billion in euros. And then net margin, they're actually profitable now. I did not know that. So
I didn't either.
5% net. And that puts you at about 600 million
Mm-hmm.
in profits. So hey, they have figured it out from profit perspective, at least for now. ROIC is still super, super low, but over the last 5 years, growing at almost 18% annually for their revenues, their top line.
Yeah.
So I would definitely put this stock in the growth camp.
Yes, for
How
sure.
about you?
Yeah, definitely. It's interesting that it appears they're starting to turn a corner around profitability, because for a long time they were not. Even for a period of time, I don't think they were operationally profitable either. So the fact that they have kind of started to become, I wouldn't say more mature company, but maybe they're starting to kind of turn a corner from, you know, a growthy company to maybe being able to fund themselves. Which is great for them and great for the people that have held the company all these years. I'm sure their returns have been very nice.
Profitability, they've had 5 quarters of profitability.
Okay.
Starting in March of 2024. This
Okay.
last quarter, they've gone back to negative, but yeah, so 5 quarters, not bad.
Not bad. Not bad. And it's interesting too that they've done, would you say 16 billion or so in revenue? It was in euros. So considering, to look at the revenue sizes of the companies, McDonald's was doing 26 billion in revenue, and you think of them as like this massive company, and Spotify is a digital business, and they're in the ballpark. I mean, yeah, they're maybe 10 billion less, but still they're in the ballpark for a digital app, which is impressive.
Yeah, I mean, PE is like 155. So these numbers look really similar to Tesla's, other than the fact that Tesla's like 5 times bigger.
Right.
But stock chart looks similar. The numbers look similar. For whatever reason, investors hate Tesla, but they love Spotify.
Yeah.
We won't go there.
Right.
You want to look at Apple?
Yeah, let's look at Apple.
Everybody looks at Apple. Everybody knows Apple. Let's see if there's anything interesting that we can pull out for Apple. 408 billion in revenue on 24, almost 25% net margins. That is 100 billion in profit a year. 100 billion in profit a year.
Right.
I don't know what the GDP for some countries are.
But it's got to be, yeah.
That puts them up there, doesn't it?
Oh,
100 billion in profit.
Right. Well, think about it. All the companies that we just, like the last 4 or 5 companies that we've talked about, if you add up all the revenues, they don't probably get to 100 billion.
No, I don't think so. Take out Tesla. Yeah, maybe even with Tesla, they wouldn't. Right. No, they would not.
So that's insane.
Yeah. It is quite insane. They've had a slowdown lately. Last 3 years, revenue's only up 1.8% a year, 2.8% for EPS. If you zoom out over a 10-year period, it's 6% for revenue and 11.8% for EPS. And those are annual numbers.
Right.
So, yeah, is it maturing? Is it slowing down? They are definitely massive. That is for sure.
For sure. I think the thing that probably would be interesting to see would be to look at their segment mix and to see which of the segments is growing the fastest. And I'm going to guess it's the services wearable part of the business is the fastest growing part. And I don't know if a lot of people know that. I think everybody associates them with the iPhone naturally.
Yeah. So 15% a year revenue growth in services for them. So to your point, yeah. And then their gross profit has been growing even faster. So gross profit at 19% a year. And the gross profit for services has almost gotten as high as the gross profit for everything else for Apple.
Wow.
So their fastest segment is almost their bigger profit segment. Give it a couple more years and maybe it'll surpass it.
Right.
So where do they get $100 billion from? A big chunk of it comes from services. And to your point, it's not necessarily. I mean, yeah, it's still greater than 50%, but that percentage is shrinking
Hmm.
compared to services. What do you
Yeah.
think about their services? Like, and what does even encompass that? Because I know for me personally, I pay for iCloud. It's like
Yep.
99 cents a month.
Yep.
Some people pay for Apple TV. What else is even out there? You pay for Apple TV.
Yeah,
Okay.
I pay for Apple TV. They have half a dozen shows or so that I really like, and I was actually thinking about subscribing to the MLS soccer thing on there as well. Um, they have the iCloud. I pay 99 cents, for the extra iCloud
Yeah.
stuff. But I know back in the day, I don't know if it's still a thing, but back in the day, iTunes was the service you used to listen to music. I've moved on from that, but that used to be a subscription as well, and I think it probably still is. I'm not sure how many people use that comparatively to Spotify. I think it's a lot of that kind of stuff, but those things are so much higher margin, especially the subscription stuff. Um,
Yeah.
Apple TV has gotten better over the years, like the programming and the things that they show on there. And frankly, I probably watch that more than I do Disney Plus. So
Yeah. It's interesting. Anywhere else you want to go? We might have to do a part two to this series. And if
yeah,
you are interested in a part two, please leave a comment on Spotify. Speaking of Spotify,
you're right.
leave us a comment there. We like to see comments there, and we definitely read them. So if you're interested, but let's do just maybe 2, 3 more, and then we'll wrap up for today. I didn't realize like there's so
A
many of
lot.
these that are really in our
Yeah.
everyday that like literally all of us
Use
use
or
or have
see.
used at some
Yeah.
point. Maybe not everybody uses Keurigs. Maybe that's just me and Dave's little uh our little bubble, but
Right.
everything else, everybody's been to
Hmm.
McDonald's, everybody's been to a
Yeah.
Domino's.
Right.
Um so
Okay. So we've gotten to work. We listened to our tunes. We got to work, and now it's time for lunch. Where do we want to go to lunch? Where do we want to go for lunch? We could go to Chipotle. We could go to
yeah.
Cava.
Yeah.
Maybe we could
Let's
go to. Let's look at those two.
Okay. Yeah, let's look at Kava. Revenue only 1 billion and net of 13%, so 130 million. So definitely out of all the stocks we've looked at, this is a baby.
Yeah, this is the
Just
smallest.
based on revenue and profits. You can see
Mhm.
it's a baby. Uh PE's come down. The stock has had quite the drawdown. They're down 55% over since their peak.
Boy,
But growing really fast over the last 3 years, 24% a year.
okay.
Pretty good.
Yeah, I have not eaten there, so I can't speak to the food. You have, right?
Yeah, I have. Um, if you're looking for something to copy Chipotle,
Mhm.
I can see where you would make that leap.
Comparison.
But the difference is when I eat at Chipotle and I get my bowl, I'm full. And it's not like the difference at Cava was my wallet was emptier and my stomach was also
Emptier.
emptier. Yeah, because you don't get nearly as much food, and that's a huge value prop for Chipotle.
Right.
So, ticker for Cava was Cava, CAVA. Ticker for
Yeah.
Chipotle is CMG. 12 billion in revenue for Chipotle. Net margin 13%. So you're looking at 1.3, 1.5 billion. So a similar scale. That 1.3 billion in profits, that seems to
Yeah.
be the trend today, doesn't it?
Right. Yeah, it does.
Uh, so I guess we've been talking a lot about mid caps. We must be, but
Mhm.
PE is higher, but not terrible. It's 37, and ROIC 5-year average according to fiscal 17%. So
Be good.
they are, yeah, growing pretty nice over the last 10 years, 10% a year. CAGR growth has accelerated over the last 3 and 5. They're
Yeah.
approaching 15% EPS over the last 10 years, 15% a year.
Are
Kind
you
of,
a bowl guy or a burrito guy?
man, I used to love their burritos so much, but I I eat there too often to have burritos all the time.
Yeah.
I
Right.
just have to get the bowls. And the bowls are actually they're really good.
Mhm.
Like
They
it
are
just
good.
feels cheesier when you get a bowl.
Right. Yeah.
Pro tip: don't get lettuce. Actually, and
Right.
it feels way cheesier.
Right.
Yeah,
Okay.
for you cheese
Yeah.
guys out there
Right.
and girls. Yeah.
Yeah.
All right. Let's make our way home. Winding down for the night. Maybe anything else comes to mind, or is there before we go to bed?
We're on our way home. We need to pick up something for dinner for the family. So we
Mhm.
either need to go to the grocery store and pick something up, or we stop at some place and get something to go.
Yeah.
So
Now you're just trying to make me. You just keep pulling the knife in deeper. And you had to start with McDonald's too, right now, because
right.
I want junk food. I want fast. But yeah, let's look at some grocery stores because there's actually a ton.
Yeah.
Kroger Company being
Yeah.
one,
Mhm.
ticker KR, revenue 150 billion, net of only 1.8%. So
Narrow.
guess where that leaves us. I'm not gonna do the math. Well, okay. Almost 3 billion in profit. We'll
Okay.
round about 3 billion. So we're again at that
Yeah. Same
size. This
size. Yeah.
this 1, 2, 3 billion in profit seems to be the trend today,
Right. Yeah. So I
which is
mean,
weird.
yeah. Put that in perspective. Chipotle was what 1.3 ish or so billion in revenue on a fraction
Profit.
of of profit, which is on a fraction of the revenue that Kroger was
Mhm.
putting out there, and
Yeah.
so you know it just okay. That's really interesting. Like they're doing these huge numbers in revenue, but the profitability of the business is so much lower.
Yeah. I mean, okay, here's my takeaway from some of this. The value extraction when you go to the grocery store and you get mad at rising inflation and stuff, get mad at Procter and Gamble.
Right.
Don't get mad at Kroger
Mm-hmm.
or Costco.
Right. Because they're not making much.
No. No, not at all. Not
They're
on that.
making 1% on the bananas that they sell us. Maybe it's a little more, but still, it's there's not a lot of profit there to squeeze.
No, not at all. Low, 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 1-2% a year
Mm,
growth in revenue. So
yeah,
yeah, they're growing like a mature Procter and Gamble, old
yeah,
Johnson and Johnson.
yeah,
Yeah.
yeah. Definitely a stage 5 kind of company
Hmm.
for sure.
What is another grocery store?
We could look at how about Sprouts?
Okay. What is your guess for their revenue?
7 billion.
Wow, you are on today. Okay. 8.4 billion in revenue.
Oh,
So
okay.
very close. Net of 5-6%. So we're talking about 500 million,
Okay.
800 million
Yeah.
in profit.
Okay. Interesting that a competing grocery store has 5 times higher profit margin than Kroger does, which is kind of
It
interesting.
does. It
So
does. And
yeah,
you would
so
understand it if you went in one. Have you been in one?
no, I've never shopped at one.
Yeah, it is expensive.
Okay, so it's kind of like Whole Foods, your whole wallet kind of place.
Yeah, exactly. But they are growing nicely, growing revenues at 10% annually, growing EPS at 20% annually. They have definitely grown pretty well up to now.
Yeah, that's awesome. So two different grocery stores, but you have basically two different profiles of what kind of businesses you could be investing in.
Yeah,
One far more
100%.
far more mature, and another one that's a little younger and growing faster, and probably riskier too. So you have
Yes.
a different profile to think about. So if you are interested in that space, you have choices, but you also have different risks to consider as well.
Yeah, very well said.
All right. Okay, well, I think that'll conclude part 1 of our discussion on everyday stocks that you may have never thought about. All right. Well, with that, we will go ahead and wrap up today's show. As Andrew said, if you enjoyed this conversation today and would like a part 2 and hear some more about stocks you can find in your everyday life, leave us a message, a note in Spotify, and we will get back to you. We always love to see those little notes, so please tell us what you're thinking. And with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.